Imagine taking $2.3 billion of your customers' money, completely stopping all interest payments to them, and, having those customers be absolutely thrilled about it.
I mean, it sounds like magic, right?
Hmm.
But it's just really clever banking.
Exactly. And yesterday, April 20th, 2026, Zion's Bancorporation revealed they pulled off exactly that trick. This was in their first quarter earnings report. We've got the full release and their financial review presentation right here on the table.
Yeah, it's a dense stack of spreadsheets, I'm not going to
All
lie.
right, so our mission for this deep dive is to basically tear apart that corporate speak. We're going to look under the hood of a major U.S. regional bank, one that operates across 11 Western states.
And, for anyone listening who thinks bank earnings are just dry accounting, regional banks are basically the circulatory system of the Main Street economy.
Oh, for sure.
Like when you look at how a bank like Zion's manages its cash flow, who they deny loans to, how they handle their risk, you're getting a real-time diagnostic of the broader economic climate.
Which impacts all of us.
Exactly. It tells you what's about to happen to the businesses operating right in your own neighborhood. So you really want to pay attention.
Which is exactly why we need to cut through the jargon. So let's start with the headline numbers, the ones that trigger the stock market algorithms the second the report drops. For the first quarter of 2026, Zion's reported net earnings of $232 million.
Right?
And that breaks down to $1.56 per diluted share.
But, the immediate narrative around that $1.56 per share is, well, that's where the data gets incredibly slippery.
How so?
Because if you just look at the year-over-year comparison, that is a massive 37% increase in net earnings compared to the first quarter of 2025.
Which sounds amazing.
It does. But if you look at the sequential comparison, meaning you compare it to just the previous quarter, Q4 of 2025, it's actually an 11% decline.
Oh, wow.
Yeah.
So if you're an investor scanning the headlines, you're either popping champagne over a 37% explosion in profit or you're panicking over an 11% slump.
Exactly. It depends entirely on which time frame you happen to glance at.
And their CEO, Harris H. Simmons, he bypassed both of those numbers in his quote. He highlighted something called a positive operating leverage of 2.7%.
Yeah, that's the real metric management cares about.
But let's establish some baseline reality here first, because I am highly suspicious of a 37% jump in banking profit in a single year. I mean, unless they literally discovered a gold mine under the vault, what is causing that optical illusion?
Right. So the illusion is caused by accounting necessities, things that drag down those comparative quarters. You really have to look at the notable items section of the release.
Okay, lay it on me.
So in the first quarter of 2025, Zion's took an 11-cent per share negative hit to their earnings.
Ouch.
Yeah, but this wasn't because they made bad loans. It was actually because newly enacted state tax legislation forced them to aggressively revalue their deferred tax assets downward.
Oh, I see.
And then, fast forward to the previous quarter, Q4 of 2025. They recorded a $15 million charitable contribution to the Zion's Foundation.
Which is great for charity, but...
Right, but that philanthropic move took an 8-cent bite out of their earnings per share.
Okay, so it's like trying to compare a runner's sprint times across 3 totally different races. Like, last year, the track was covered in thick mud because of that tax legislation hit.
That's a great way to look at it.
And then last quarter, the runner decided to just stop and hand out water to the crowd, which is the charitable donation.
Yeah, that's a highly accurate way to visualize it.
Yeah.
And this quarter, Q1 2026, the track was completely dry. No mud, no distractions.
It just ran.
Exactly.
Yeah.
They had 0 notable items over 5 cents per share. So that 37% year-over-year jump, it's not really explosive market capture. It's just a return to a clean, unobstructed baseline.
Okay, so the track is clear. The mud is gone.
Let's go back to the CEO's quote then.
Yeah.
He touted a positive operating leverage of 2.7%. Getting a clean baseline is step one. Why is this specific metric the ultimate goal?
Well, positive operating leverage is essentially the mathematical proof that a business is scaling efficiently.
It means the rate at which your revenue is growing is outpacing the rate at which your expenses are growing.
Got it.
So in this specific quarter, Zion's grew their adjusted taxable equivalent revenue by 7.4%. But over that same time frame, their adjusted operating expenses only grew by 4.7%.
Oh, so the 2.7% difference is that positive operating leverage.
You got it.
And
To put it simply, they're generating more dollars coming in without having to proportionally increase the dollars going out to pay for, SaaS or software or real estate.
That makes sense. So if positive operating leverage is the goal, how exactly are they widening that gap? Because that brings us to the foundational engine of the bank, right? The net
Yeah.
interest income.
Yeah, the NII.
Right, which is just the spread between what they pay you for your deposits and what they charge a business for a loan.
Exactly. And the documents show net interest income landed at $662 million.
Which is a lot of money.
It is. That's up 6% year over year, but it is actually down 3% from the last quarter.
Right. And their net interest margin, the NIM that came in at 3.27%. But here is the data point that totally stops me in my tracks.
Okay, what is it?
The yield they're making on their earning assets, so basically the loans they give out, actually dropped this quarter. It went down to 4.90%.
Right.
And usually if a bank is earning less on its loans, I mean, its profit margin gets crushed. But Zions managed to push the total cost of their deposits down to 1.48%.
Yeah, they did.
That's a decrease of 8 basis points from the prior quarter and a full 28 basis points lower than a year ago.
But hold on, let's just define basis points for a second to keep scale clear for everyone.
Sure. A basis point is simply 1/100th of 1%.
Okay.
So an 8 basis point drop means their cost of funding fell by 0.08%. I mean, it sounds microscopic.
It really does.
But when you're applying that to tens of billions of dollars, it equals massive swings in profitability. They successfully protected their overall margin because they managed to force the cost of their deposits down faster than the yields on their loans were falling. And that brings me right back to the $2.3 billion trick I mentioned at the top of the show.
Yes. The deposit shift.
Yeah, so Zions grew their total deposits to $76.9 billion. But inside that total non-interest-bearing demand deposits, so meaning checking accounts that pay the customer literally 0% interest, those shot up by $2.3 billion.
Right.
And the documents state this was largely because a consumer interest-bearing product migrated into a new non-interest-bearing offering. My question is, how do you convince a consumer to voluntarily give up the interest they were earning on their own money?
You leverage behavioral economics.
Okay, tell me more.
Well, the consumer isn't acting irrationally. They are just doing the math on utility versus yield.
Right.
Let's say you have $5,000 sitting in a basic interest-bearing account, and it's yielding 1% annually. You are making $50 a year in interest.
Woohoo! $50.
Exactly. But that account might come with a $12 monthly maintenance fee if your balance dips. Or maybe it charges you for out-of-network ATM withdrawals. Or it lacks premium digital fraud protections.
Ah, I see where this is going. So the bank introduces a brand new checking product. They go to the customer and say, hey, we will waive all monthly maintenance fees. We'll give you early access to your direct deposit paycheck, drop all ATM fees, but the account pays 0 interest.
Yes. And the customer realizes that paying $144 a year in potential maintenance fees just to earn $50 in interest is a losing battle.
Right. It's terrible math for the consumer.
So they migrate to the zero interest account to secure the fee waivers and all that software utility. For the customer, it's a highly logical fee avoidance play.
And for the bank.
For the bank, it is an absolute masterstroke. They just traded some software features and fee waivers for $2.3 billion of completely free capital, and now they can turn around and lend that out at nearly 5%.
That is incredible. I mean, they're essentially buying free funding with convenience.
That's exactly what they're doing.
And the documents show that while they were scooping up this free consumer cash, they were actively dumping $3.8 billion in broker deposits and short-term borrowings.
Yeah, they were cleaning house.
So what's the strategic difference there between a consumer checking account and a brokered deposit?
So broker deposits are what the industry calls hot money.
Hot money.
Yeah, when a bank needs to pad its balance sheet quickly, maybe to meet regulatory requirements or fund a sudden surge in loans, they can go to a third-party broker and just buy massive blocks of deposits.
Okay.
But because they're buying wholesale money, they have to pay a very high premium interest rate. And worse, that money has absolutely no loyalty.
Because it's just chasing yield.
Exactly. The second a competing bank offers 0.1% higher yield, the broker moves the money out of your bank.
So it's super expensive, and it's a massive flight risk.
Highly volatile. So by shedding $3.8 billion in that expensive, flighty hot money and replacing it with the free consumer core deposits.
Yeah.
And then on top of that, securing an additional $1.0 billion increase in stable long-term debt through recent senior notes management, has fundamentally bulletproofed their liability structure.
Wow. Okay, so shedding the expensive hot money is a great defensive play. But you just noted a minute ago that their yield on earning assets dropped to 4.90%.
I did, yeah.
If they are making slightly less on their actual loans, where is the aggressive growth coming from to hit that positive operating leverage? Because you can't just shrink your way to growth, right?
No, you really can't. They have to diversify away from traditional balance sheet lending.
Okay.
If you look at the presentation, it highlights that customer-related non-interest income was $172 million. That's up 9% year over year.
Nice.
And they generated this through increased retail and business banking fees, specifically calling out higher overdraft fee income, along with the boost in residential mortgage loan sales.
Right, the fees.
But the true growth engine they are building is actually buried in an acquisition announcement.
Oh, yes. Zions reached an agreement to acquire the agency lending business of Basis Multifamily Finance A, LLC.
That's the one.
And the documents outline that this allows Zions to originate, underwrite, and service loans through government-sponsored programs, things like Fannie Mae DUS and Freddie Mac Optigo. Break down the mechanics of this for us. How does agency lending differ from, a normal loan Zions would make to a property developer?
Sure. So in a traditional commercial real estate loan, Zions lends their own depositors' money to a developer to build an apartment complex.
Okay.
The loan sits on Zions' balance sheet. If that developer goes bankrupt, Zions absorbs the financial loss. It's capital intensive and it carries massive credit risk. Agency lending completely flips that model.
Flips it hard.
Under a program like Fannie Mae DUS, which stands for Delegated Underwriting and Servicing Fannie Mae, grants the bank the authority to underwrite the loan to Fannie Mae's strict standards.
Right.
The bank funds the loan, but immediately sells it to the government-sponsored enterprise. Fannie Mae buys the loan and assumes the vast majority of the credit risk.
Wait, really? So the bank doesn't even keep the loan on its balance sheet?
Exactly. Instead, the bank retains the servicing rights.
Meaning they basically act as the middleman, like collecting the rent checks and managing the property's escrow accounts.
Precisely. They collect a steady, recurring stream of fee income for the life of the loan just for doing the administrative paperwork.
Wow.
By acquiring Basis Multifamily, Zions is pivoting away from being a casino where their own capital is at risk and transforming into a toll booth.
A toll booth. I love that.
Right. They get the recurring revenue of the real estate market without holding all that toxic risk on their own books.
But if management is that eager to move into risk-free government toll booths, it makes me wonder what they're seeing in their traditional risk-heavy commercial real estate portfolio.
That's a fair question.
Are they pivoting because their current loans are bleeding? Because we've all seen the headlines about empty downtown office buildings and failing commercial properties.
Yeah, the headlines are scary, but the data suggests they aren't fleeing a fire. They're actually managing the existing portfolio incredibly well.
Really?
Yeah. Look at the net loan and lease charge-offs. This is the actual money they had to formally write off as uncollectible. It was exceptionally low. They only charge off $4 million for the entire quarter.
Wait, $4 million?
Yeah. That translates to an annualized ratio of 0.03% to average loans.
$4 million on a loan book worth tens of billions is basically a rounding error.
It is incredibly low. And furthermore, they're classified loans, which are the specific loans that their internal risk officers flag as having a higher probability of default.
The problem loans.
Exactly. Those dropped a massive 19% year over year down to $2.3 billion. And the report explicitly notes this drop was driven mostly by commercial real estate loan payoffs.
So borrowers are actually successfully paying back their commercial real estate loans.
They are.
Which leads to what I think is the single most shocking line item in this entire earnings release. Because these commercial real estate loans paid off successfully, Zions recorded a negative $7 million provision for credit losses.
Yep.
And last year, in the same quarter, they added $18 million to their reserves. But this quarter, their total allowance for credit losses dropped to $713 million.
Explain the mechanism of a negative provision for us. Are they just randomly deciding to put cash back on the balance sheet to boost their earnings?
No, it's definitely not a subjective choice by the CEO. It's dictated by really rigid accounting algorithms under a standard called CECL.
CECL.
Yeah, it stands for Current Expected Credit Losses. When a bank originates a loan, the algorithm looks at the macroeconomic forecast and forces the bank to set aside a specific amount of cash into a reserve fund.
Which is the allowance for credit losses.
Right. And that cash is to cover potential future defaults. It hits their earnings immediately.
Okay, so it's like paying for a massive flood insurance premium on a beachfront property you just bought. Exactly that. Now, what happens when the developer successfully pays off that commercial real estate loan? The bank no longer holds the risk of that specific loan.
Right.
So the CECL algorithm recognizes that the specific risk has evaporated.
Ah, okay. You successfully sold the beachfront house, so you just cancel the flood insurance policy. And the insurance company sends you a $7 million refund check for the unused premium.
And that refund check goes straight back into the bank's earnings. That is a negative provision. The successful CRE payoffs literally forced the model to release the reserves tied to those specific loans.
Okay, I understand the algorithm demands the release, but I really have to push back on the optics of this.
Okay, let's hear it.
Is taking $7 million away from your rainy day fund actually a wise move right now?
Yeah.
Because if you read the forward-looking statements in Zion's own press release, they are packed with warnings.
Oh, absolutely.
They talk about elevated inflation, the ballooning national debt, shifting timelines for federal interest rate cuts, potential government shutdowns. The macro environment feels incredibly fragile.
And it is. It's the ultimate tightrope walk for a bank's chief risk officer.
I bet.
Because you're pointing out the friction between micro-level loan performance and macro-level anxiety. On a micro level, the specific loans paid off, so the specific reserves had to be released. It actually proves their underwriting was solid.
Right.
However, if inflation reignites and the Federal Reserve is forced to hike interest rates again, creating this sudden economic squall, the macro algorithms will force Zions to aggressively rebuild that reserve fund.
Oh, man.
Yeah, releasing the reserves boosts earnings today, but it definitely leaves a thinner buffer if the broader economy suddenly cracks tomorrow.
So if the algorithms are forcing them to release cash from the reserve, and we know they aren't dumping it into risky new commercial loans, where is all this capital actually going? Like, how does it hit your wallet if you happen to hold their stock?
This is where we see the translation of all this operational discipline into tangible shareholder value.
Okay.
The numbers here are extremely aggressive. Tangible book value per common share skyrocketed 19% year over year to $41.75.
Wow.
And their estimated Common Equity Tier 1 capital ratio, or CET1, is sitting strong at 11.5%, which is well above regulatory requirements.
And then there is the line item that has absolutely plagued the banking sector for the last 2 years.
Let me guess, AOCI.
Yes, accumulated other comprehensive income. The report states Zion saw their AOCI improve by $315 million, and they credit this to increases in the fair value of available-for-sale securities and the amortization of unrealized losses. We have to translate this mechanic for a listener. What exactly is the AOCI drag, and why is it suddenly lifting?
Okay, so during the years when interest rates were near zero, banks took billions of dollars of their customers' deposits and bought safe government-backed bonds. But those bonds paid a very low yield, say 2%.
Right, because rates were zero.
Exactly. These bonds are classified as available for sale, or AFS. Then when inflation hit and the Federal Reserve rapidly raised interest rates, new bonds started paying like 5%.
So the old 2% bond sitting in the bank's vault immediately plummeted in market value because, no investor wants to buy a 2% yield when they can easily get 5% elsewhere.
Right. So the bank is suddenly holding an unrealized loss. They haven't actually lost the money because they haven't sold the bond, but accounting rules force them to record that temporary drop in market value on their balance sheet.
Ah.
That negative number is tracked in the AOCI line item. It acts as a massive anchor dragging down the bank's total reported equity.
So what changes to make the AOCI improve by $315 million this quarter?
Two things. First, if broader market interest rates stabilize or dip slightly, the fair market value of those older bonds recovers a bit.
Okay.
Second, and more importantly, the amortization of unrealized losses. That simply means the bonds are getting closer to their maturity date.
Oh, I see.
And think of it like a 10-year bond. In year one, a massive rate hike destroys its resale value. But by year 9, it doesn't matter what the current market rates are because the government is about to pay you back the full 100% par value in 12 months anyway.
Oh, right.
So as the bond ages toward maturity, that unrealized loss just evaporates.
The anchor is lifted, and the overall equity of the bank springs upward, which flows directly into tangible book value.
Exactly.
And if you're looking at your portfolio, tangible book value is really the ultimate test of intrinsic worth. If you shut down Zion's tomorrow, liquidated every asset, paid back every depositor, settled every debt, and stripped out imaginary concepts like brand value, Tangible book value is the cold, hard cash left on the table for the shareholders.
Yes.
So growing that absolute floor by 19% in a single year to $41.75 a share is a massive signal of fundamental health.
And because they are sitting on that growing intrinsic value, they are deploying capital to reward the investors. They kept their quarterly dividend steady at 45 cents a share, but they aggressively ramped up share buybacks.
Oh, they did?
Yeah, they repurchased 1.3 million shares for $77 million this quarter. To give you context, a year ago, they only spent $41 million on buybacks.
But wait, if they have all this excess capital, why choose to buy back stock instead of just doubling the dividend payout to the shareholders?
Because dividends are an implicit promise. Once you raise them, cutting them later sends a huge panic signal to the market.
Oh, that's true.
Buybacks are flexible. And more importantly, when management looks at their rising tangible book value, buying back their own stock is them declaring to the market, we believe our own shares are deeply undervalued, and buying them is the highest return on investment we can make.
Plus, it shrinks the pool of shares.
Exactly. It permanently reduces the total number of shares in existence. So instantly, every remaining share you own represents a larger percentage of the bank's total earnings.
It's just smart capital allocation. So bring this entire deep dive together. Zions Bancorporation basically just executed a textbook cleanup quarter.
They really did.
They engineered a brilliant deposit shift, shedding all that expensive, volatile, hot money and trading fee waivers for billions in free consumer deposits. They successfully navigated commercial real estate payoffs, which triggered those algorithms to release $7 million from their credit loss reserves.
Yeah.
They're optimizing their fee structures, buying back their own stock with confidence, and quietly executing a massive strategic pivot toward government-backed, risk-free agency lending with the basis multifamily acquisition.
It is a quarter defined entirely by structural discipline. They are pulling every lever available to cut funding costs while actively shifting their revenue mix toward capital-light, fee-generating sources.
Right.
They achieved their goal of positive operating leverage by forcing efficiency rather than just riding a wave of new risky loans.
But that leaves us with a lingering question, something for you to keep a close eye on as the rest of the year unfolds. Zions just confidently released $7 million from its rainy day fund because the math of today's commercial real estate payoffs demanded it. They canceled the flood insurance. But considering the unpredictable nature of inflation, shifting national interest rates, and the evolving macroeconomic challenges that they highlighted in their own forward-looking statements, what happens if this current Goldilocks scenario for regional banks faces a sudden, unforeseen squall? Did they cancel the insurance policy just a moment too soon? We will have to wait for the next quarter's data to find out. Thanks for joining us on this deep dive.